Everyone talks about stocks, but if you ignore the bond market, you're basically driving blind because the bond market doesn't just matter, it controls the stock market. I'm Matt, a chartered accountant, and here's why even stock-only investors need to watch bonds like a hawk. When investors talk about bonds, they're really talking about interest rates, the foundation of every financial decision on earth. And those interest rates, especially government bond yields, are what we call the risk-free rate, the baseline return you can get without taking any risk. Now, here's where it links to stocks. When you value a stock, you're trying to figure out what its future profits are worth today. That's called discounted cash flow. But the discount part depends on that same risk-free rate from bonds. So when the bond yields rise, the value of those future profits fall, and suddenly even great companies look overpriced. So in simple terms, low bond yields equals cheap money and stocks boom. High bond yields equals expensive money and stocks sink. Because investors start saying, wait, why take a risk on Apple stock when I can get a guaranteed 5% return from treasuries? That's why when you see the bond market selling off, interest rates climbing and yields spiking, it's not just bonds. It's a signal that the cost of money is rising and valuations across the stock market are about to adjust. So the next time you check your portfolio, don't just look at stock charts. Check where the 10-year bond yield is headed, because that number quietly tells you how expensive or cheap your stocks really are. Follow for more smart money insights explained simply.